Welcome back, options traders. Jake here. In this video, let's talk about an advanced options trading strategy, which is the reverse iron butterfly. Now, before you can trade the reverse iron butterfly, make sure that you're approved for the appropriate level with your broker. You basically need to be approved for vertical spreads. If I've already lost you by saying vertical spreads, then go check out my entire playlist on trading options. This can teach you basically everything you need to know about trading options. And a video you might want to watch first is on the iron butterfly, because today we're talking about basically the inverse strategy. Real quick, this is the profit and loss diagram for the iron butterfly, and it's just two credit spreads. It's a call credit spread and a put debit spread, and you're hoping the share price of the company doesn't move. Your short legs are at the money, and this is your max profit if the share price of the company stays exactly where it is at the money on the day that you bought these two credit spreads. So if you're doing the reverse of this strategy, then basically you want the share price of the company to dramatically move. Instead of receiving a net payment like you are with the iron butterfly, you're paying a debit. You're paying money to get into this trade. So your long legs now are entirely at the money, and if the share price of the company doesn't move at all over a 2-week or 1-month period or whatever you're trading this as, then your max loss is right at the money where you bought your call debit spread and your put debit spread. So you really need the share price of the company to move to make any money at all. So we'll go through basically how you set this up, and then we'll do a live example on my Schwab brokerage account. So quick recap of the regular iron butterfly. Once again, you're selling the two kinds of credit spreads on the call side and the put side, receiving a net payment today. With the reverse iron butterfly, you're buying a call spread and buying a put spread with your long leg being at the money. Once again, just visually trying to help you recognize what's going on here. Basically, with the iron butterfly, you think it's not going to move, but with the reverse iron butterfly, you're hoping it moves dramatically in one direction or another. You don't care. You're simultaneously betting that it'll either go up dramatically or going down dramatically. Why would you do this? Well, maybe there's a big announcement for a company coming soon, or they're going to have a very important quarterly earnings report that's make or break for the company, or it's just a very volatile stock and it's jumping around a lot, both up and down, and you're saying, is there a way that I can trade and make money off of this volatility? So how would you set this up? First, you would do the call side debit spread. Once again, you're buying your long call at the money. So whatever the closest strike price to the current share price today, that's a call you're buying. And if the share price takes off, that's pretty good for you. You wouldn't mind that. However, buying a full call contract can be kind of expensive. So when you think about, well, can I bet both directions, the call side and the put side, that's a different options trading strategy. That's the long straddle. I already made a video about this, and once again, you would do the long straddle basically on an earnings report. You think the share price of the company is either going to go dramatically up or dramatically down. The problem with the long straddle, though, is that these contracts are very expensive, the call and the put, which gives you a very high break-even price. You have to overcome basically one of these contracts being completely worthless because it took off in the other direction. It's still doable, but the appeal of the reverse iron butterfly is basically lowering your break-even, lowering your cost basis for the trade, but the downside is you're limiting your upside as well. So when you sell a call against the call that you bought, you're paying a large amount of money for this contract. You're then getting back a payment for a lesser amount for this contract. So if the share price of the company takes off, as soon as it goes past where you sold a call, you can't make any more money anymore. You're losing money above in this upper region at the same rates by expiration that you're making money on the call that you bought down here. So you're capping how much potentially you can make on the upside, but you don't care. So you got the call side for the reverse iron butterfly. We're now going to do the put side. So you buy a put And once again, just buying the call and buying the put is a straddle, but we need to lower our costs. So we're now going to sell a put against it. And just like with the call side, if this were to dramatically go down and you just had a put on it, you'd be making more money, but it cost you more money to get into the trade. So you're going to sell a put, pay a large amount here, receive a payment back, and if the share price just, blows past where you sold the put, keeps going down, it doesn't matter. You can't make any more money because you capped your gains with this sold put. So how do you make your max profit? Well, ideally, you want the share price of the company to go straight to where you sold a call or you sold a put, because the put that you bought or the call that you bought will gain in value faster by expiration. So that's the strategy here, and we'll do a live example so you can understand the numbers basically. But how do you lose all your money on this trade? Well, because you're buying both sides of where the share price can go, you have a very high break-even cost. You have to overcome the cost you're paying for both of these spreads. So if the share price only goes a little bit up or a little bit down or trades sideways, then theta decay will eat away the value of your contracts. You won't overcome your break-even cost, and you'll just lose most of your money. So your max loss is the total net debit you pay for all 4 of these contracts. Your max gain is the width of the strikes, either on the call side or the put side, minus the net debit you're paying. And your break-even is the at-the-money strike plus or minus the net debit you're paying for both of these spreads. So if you think you got it, if you want to rewatch it, you can, but if you think you got it, let's now do an example with real numbers. So here's the option chain for Apple. We're going to do our example on Apple, but I'm not actually going to buy this reverse iron butterfly. I just want to show you what's possible here. So currently, Apple's share price is at $179 a share. However, it's recently broken out. So potentially it could go up higher to a nice round number, 190 or 200. Or maybe investors are saying there's going to be a contraction in the market, this breakout's not going to last, I'm going to take profits and sell. So potentially it could drop back down to 170 or a line of support here at 160. So my theory is that Apple's not going to stay here. It's not going to stay perfectly at 180. It's either going to drop $10 a share or go up $10 a share. So let's set this up, and we're going to give myself plenty of time. Obviously, if you want to do a weekly contract or 2 weeks, there will be more dramatic ups and downs, but I always like giving myself basically a month. So I'm currently filming this video on December 15th. Let's choose an expiration date of January 21st. That's the 3rd Friday of the month. This is in 37 days. Let's add some strikes here so we can see more information. Once again, the share price is at 179, so at the money is 180. These are the calls and the puts that we're going to be buying. And I'm going to choose a width of $10. You can choose whatever width you want. I just like going with $10. Let's scroll back to the top and we'll build this. And once again, we're buying to open the at-the-money calls and puts, and we're selling to open to cap our upside and downside gains to get back, a little bit of money at 170 and 190. Schwab right here recognizes this as the iron butterfly, but once again, this is the reverse iron butterfly. And I'm going to have to pay a debit today to get into this trade of $798. Okay, well, how much can I make on this? So here's the main trade page, and let's do a couple things here. Let's switch this to market order, and then we'll go down to trade and probability calculator. So Schwab shows me exactly what is my max loss if I get into this position, and it's $798, kind of a lot. And what's my max profit? 202. Doesn't seem like a good ratio, but once again, you're betting that the share price is not going to stay put. If it can just in the next 37 days get above 190 or below 170, you got to ask yourself, is that big of a range to basically guarantee myself this money? And if you're just not interested in a $202 profit, you can go ahead and increase these all to 10 might be crazy. How much you're risking, once again, max loss 7,980 to make 2,020. It's interesting. I like the theory behind the reverse iron butterfly to say, I'm just going to play both sides. I'm confident that this stock is very volatile. It's shooting up and down. I want to play it where I can get into a spread on both sides. And with your broker, hopefully you don't have to hold both legs. Let's say that Apple, once again, is being volatile and shoots down. It drops below that 170 on the put side. I can close this leg for a profit and let this leg continue on. And maybe a couple days later, Apple shoots back. Even if it gets back to the at the money 180 strike, I can then close this for more profit than I would have if I held it till expiration or I sold it when I got out of the put side leg of the trade. Okay guys, there you have it. That's the reverse iron butterfly. I hope you found this video informative. If you guys like this kind of content, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.